our shareholders are always brilliant with Q&A, but I might start off with a question that came in ahead of time from Michael. He asked us, how do we plan to balance the payout ratio of our income and our dividend with the share price growth? And I was going to answer that, but I thought, Miles, why don't you give that a go?
Well, I mean, it's tremendously easy. We're going to increase the dividend, increase the payout, and we're just going to generate ludicrously high returns. I mean, the challenge we have, so we generate the returns we do, and we work really hard with, to do that. Then in terms of how we distribute the returns, it's really a board decision, but they can only work within the confines of what we've generated. So if we make a 10% return, there's 10% to play with. Over the life of the fund, we've generated an 11% net return. I think we've paid out 80 to 90%.
90 cents on the dollar.
And I think in more, so I guess the problem that you have two parts of the register, some that want dividend at all costs and others that would like to see the share price growing a little bit and some capital growth.
Yeah.
I think the board's trying to straddle those two kind of competing tensions as best they can. More recently, I think we've let the capital growth tick ahead. So the NTA has been increasing without increasing the dividend. We tried to balance that tension last year with paying the 1 cent special, but I think, my own personal view, as I guess as one of the directors, is the dividend has been very high for a long period of time. I don't feel a need to really ramp it up too much higher than where it is now. But it's also all of your companies. So if anyone has a view or an opinion, please let me know, and I will make sure the board knows. And all of that is a caveat to saying I don't think there's a perfect answer to keep everyone in the church perfectly happy.
This chart here, just for everyone's benefit, this chart shows if you had reinvested everything, so maybe a grandchild or a child, you reinvested everything, your 10,000 would now be worth, well, it would have tripled in the last 11 years. The second one is we do have more and more investors doing half and half. They take half the dividend, they reinvest the other half. That gives you that scenario. And that last scenario there, as Miles said, we listed at $1. It's worth $1.35 today, and we've paid 90 cents out on the dollar. Does that answer your question, Mike?
Yeah, it's always a balance.
I know, right?
Would you like to see the capital growth a bit higher? Is that?
Well, I'm really pleased to see that the share price was sort of
stuck
to $1.10
for a long time.
Yes.
Yeah.
I think people probably are just more relaxed about the general investment.
Yeah, with it going up, trending upward.
Yeah.
It's that baby, the third baby. I blame him.
Okay.
The balance is about right for me anyway.
Okay.
Okay, that's great, Mike. Thank you. Please don't be shy. Come on. Usually we have great questions.
Yeah.
With the increase in private capital and private debt, is that making it more difficult to provide a fully franked dividend as compared to a publicly listed organisation?
Well, for us, no. So where we generate most of our returns is buying these assets cheaply and unlocking the value from them. So for us, it's really, we're generating capital returns. We're an Australian listed company, so we pay tax in Australia. Paying tax generates franking credits. That's how we do it. So it's not that we pay a high dividend because we're streaming high levels of income in. I think for other people in the market, possibly the case, as particularly as a lot of these are offshore opportunities. But yeah, it is. I mean, it's a big change that's going on, and one that I don't think people really focus on as much as perhaps they should.
I asked a similar question of Jeff Wilson as part of his WMX one, as far as how does he, with I think it's 40% corporate debt as part of his new fund.
Yes.
How does he manage to still target a fully franked dividend when almost half of it is actually debt rather than?
Yeah. Did
What
he have
was
a good
his
What was
answer?
his answer? Yeah, I'm curious.
I'm interested.
I don't think he got to it because that was about 3.5 hours into the webcast.
Okay.
Oh, okay, ran out of steam.
I'm not sure if he actually got to it.
Well, I mean, to the extent that they generate returns on the bonds and pay tax, that would be a source of franking, I think.
Yeah.
Yeah.
Phil, you had a question?
Yes, well, first of all, congratulations on the GVF performance.
Thanks.
Thank you for the GVF performance. I was interested when you said, talking about the discount capture, and you said there were about 100 companies in Australia. I was wondering what you based that on.
So I looked at there's an organisation called Listed, and it lists all of the listed investment companies and the listed investment trusts, and there's about 100 of those. I can point you to the website if that's helpful. But yeah, there's quite a few. There's the AFIC, the Argos. Those are the big ones that you would know. the Mirror Bookers. These are all listed investment companies that can trade at a discount and are trading at a discount.
G'day. Sorry.
Hi, I'm Steve.
G'day, Steve.
First of all, congratulations, thanks, lovely
Thank
fun. Just a cheeky question. If you did start another fund, well as GVF, what would it be?
Well, we have started another fund about 3 or 4 years
We're
ago
not
now.
doing another fund.
We're not
I can't do
doing
it. I can't do it. I
But,
genuinely.
I mean, and really the only difference with the other fund is it's for kind of institutional type investors and it has a more risk-seeking mandate.
Yeah, we've
So
got
it's
a
little bit-
second and last fund called Staude Value Fund. It's almost identical to GVF except it's in US dollars. It has a 2 million minimum. It's in the Caymans and it has a 2-year lockup. So it's very.
But philosophically, he's asking me what we'd like to do. I mean, I love running GVF. We geek out on sharp ratios and managing risk and all that kind of stuff. But the other fund does run with a little bit more high octane, not crazy, but it's seeking higher returns with, can accept down years and can accept higher volatility. Yeah.
What about us? Can we ask a question of the audience? Could you please put your hand up if you would prefer monthly income as opposed to semi-annual income? One person, great. Okay, I don't have to change that then.
Or quarterly, would that move the dial for anyone? Is that really?
Okay,
No?
great.
Okay.
Thanks, guys. Thanks.
Okay, that's good. That makes life easy.
Keep
Sorry.
it interesting.
Democracy is a horrible thing.
A year ago, you were sort of trading at a discount to NTA,
Yep.
now at or above NTA. The fact that you're not raising additional capital, does that kind of say, is that a view on your opportunity set out there at the moment? Like, if you were to raise,
Oh, no. Yeah.
No.
is there lots of excitement out there for you?
Nix.
The,
I'll take it. Oh, no, I was
No,
it.
well, we'll dance. I mean, just to say, from the very beginning, so we started off as a very small fund, $50 million, and we said from the beginning, we never want GVF to be much more than 300. So we've grown along the way through capital raisings, always at parity or above, and we've paid out most of our income through the way. So we've really grown from 500 to 220 through raising money. We're certainly not raising money through any view on the market. The opportunity set is where we'd always want it to be. We were frustrated that we're a little bit of a discount last year. We've worked very hard to get rid of that. But no, I mean, there's
there are funds overseas in the US and the UK that run billions in this strategy. They just don't have the alpha returns that we have. And so we've said from the beginning, we don't want to run more than 300 in GVF. And that's actually a tiny amount on a 600 billion US dollar area that we cover. So it's definitely not an opportunity set thing. And you're right, we haven't raised money since December 2020, so it's been a while. I think, from a board perspective, listening to what the board says, and obviously it's a board decision, my gut feel, or at least my feeling, was that trading at a premium for a little while was a bit tasteful. I think, let's do that for a little while,
we have had a lot of people ask the
But
question.
yes, we understand that might be attractive to people. Yes, please, go ahead.
Hi.
I'm a very small investor and I have shares in Australian companies mainly.
Yep.
But what you were talking about was the growth in unlisted companies, private companies. How am I supposed to access that sector?
Well, we hope through GVF you're
Well,
accessing
I have
some.
got GVF,
Yeah.
but
Elsewhere.
elsewhere.
I mean, it's hard, and it's sort of big picture. One of the frustrations I have, and I think passive investing has been a wonderful development, but there's a counter side to that. So I think the rise of passive has forced a lot of these interesting opportunities out of the public arena, and one of the problems that governments have to straddle is that they need to do regulation, they need to put laws and restrictions around people, and they've done that in spades in the public market, but it's just made the public market a lot less exciting. So you take away opportunities. While you protect investors on one hand, you remove opportunities on the other hand. There are opportunities in Australia. So the Wilson franchise run a private fund that's quite interesting. I actually used to serve on the board of WAM Alternative Assets.
Yeah.
Has some interesting agricultural assets and other private equity investments.
There's a private equity. Yeah,
There's
there's a couple of private equity licks in that universe of 100 companies.
There's a Pengana one that I'm not saying they're good or bad companies, I'm just saying that they're out there. And then I guess the alternative is you go into one of these funds directly, but then you are locking yourself up for 5-10 years. and you generally have to put in a lot of money up front. So unfortunately, there isn't really an easy fix. Unfortunately,
I have another
please,
question.
yeah,
What you were saying about America and Trump,
yeah.
you know, what's going to happen. Are we better off now investing in Australian and European companies and not investing in America?
Yeah. That, I wish I could answer that, and we'd all be, well, GVF would be through the moon if I could care to answer that. I guess the thing with the macro, it's very easy to get caught up in it. It's always very exciting, and it seems dramatic and important as you're focusing on it. But the balancing factor is really, markets price a lot of this stuff in. So everything that I've said to you about now is not new news. People that are pricing US shares are not selling them thinking, oh gosh, I didn't realise Trump was messing up the world. People buying European shares are not going, gosh, you know, there's trade wars not happening. So a lot of what we're talking about is already in the price. I think especially for say a retail investor, I wouldn't advocate you try and focus on those kind of things. I'd focus on longer term investing, trying to find opportunities that suit what you're aiming for, and not getting too caught up in what's going on.
And that is not advice.
And that is not advice. But I guess I would say, unfortunately, there isn't a lot of opportunities here in Australia. I love Australia, I'm Australian, but it's a small market. The capital markets here are not very deep. So most of the kind of new and exciting opportunities are in America and in Europe and other places around the world. Yeah. Hope that helps.
Yes.
G'day. Hi.
Jeff, I'm an original investor in GVF.
Tremendous. Thank you.
Oh, thank you.
Are there any intentions of a share purchase plan or a rights issue?
Oh, straight in there.
Well, I mean, would you
Love
like?
it. I love it.
Would you like one? I guess is the question back. I mean, we work for everyone here, not the other way around. So, I mean, we're not in a rush to raise money, but we've said we think it would help everyone if we did from time to time.
Yeah, well, I'd be interested if there was such
Yeah.
a thing.
Okay.
I don't know whether it's the intention of the board to consider anything like that.
Well, we'll take it to the board for sure.
Yeah.
Thank you. Thank you for that feedback. And just to be clear, anything that we do offer, we will offer to our existing shareholders first.
Yeah.
Yeah. We've always done that. and
We've
we
always
would
done
do
that, and we
yeah.
always will.
Yeah.
The problem with share purchase plans is that if you don't participate, well then your shareholding is diluted. And for a lot of retired people who don't want to keep investing, that's a
Well,
disadvantage.
that's a
Yeah.
great point. And I'd like to say where there are exceptions to the rule with that. So if you do a rights issue or a purchase plan and you're doing it below asset backing, then you're absolutely right. You're diluting the
Yeah.
value of the assets for everyone.
We would not do that.
We've never done that. We would not do that. So if we were to do one, and this is all kind of, we're just talking about it aloud, it would always be at the asset backing or above, in which case you're not penalised at all. We're
No.
very acutely aware of that problem.
Yeah.
I mean, but you also need to make sure that any issue is renounceable.
If it was a rights issue,
Non-renounceable.
yes.
Yes.
Because essentially that is taking value, particularly if you do the discount. I mean, the trading window
Yeah.
is such that you may well end up with a premium, and you can make it, and you can decide what you do to try and balance that out. But non-renounceables are no-nos.
Yeah.
Well,
Agreed.
Again, but only if you're at a discount. So I mean, an SPP is not a rights issue. So if it was a rights issue,
no,
I would
that's-
agree.
yeah, no.
An SPP is a special thing under the Corps Act, which isn't actually renounceable. You can't make them renounceable. But again, we've never done them at big discounts. We wouldn't do them below NTA. But all of these questions point to why it's very hard to raise money into. If you're I don't want to sound like I'm slagging off the competition, but if you're being honourable and honest to your shareholders, you want everyone to have a fair go. It's actually very hard to raise money into these vehicles. You've got to have lots of planets aligning at the right exact time. Yeah.
Yes, please.
You pointed out the challenges of the changing passive market and the private market. And you're addressing that, I guess, by being aware of it and acting accordingly. But my question really is about the future. Do you have a focus on changing anything in the way GVF operates, or do we see you going ahead in a similar way, which may increase dividends, may increase income?
So we're not going.
Where do you see the future?
Where do we see the future? So we're not going to change what we do at all. We've got a formula we stick to. We've always said we'd pay most of our returns out as yield. That's not going to change. What we wanted to highlight the big themes, just so that people are aware of what's going on, and then as a little plug to our own fund, just to say we've actually been investing in these. We've been investing in this for 10 years. We're not suddenly waking up going, gosh, we're missing out on all these opportunities. Private debt and private equity has been 20 to 30% of our portfolio since day one. I suspect it will always be that kind of range. We're not suddenly going to say, right, we want to put 70% of the portfolio into private equity. We're not going to change in that kind of radical way. We just wanted, I guess, people to be aware and to understand what's happening and what's changing out there. And maybe to have another perspective on passive investing, which I think at times just has cheerleaders only out in the industry. And passive investing has been a wonderful development, but there are other shades to it.
Shadows, yeah.
Shadows to it that I think people need to understand. G'day.
I've sort of got two questions. One is about this private equity. Are the Australian industry super funds investing in it? And then the second question is, in my day, I was taught that venture capital was very expensive. It's like a 30% return because of the risk. So it seems odd to me that you're saying the new companies are going to the venture capitalists for money when the share market investors want a much lower return.
Yeah.
It seems odd to my upbringing.
Yeah, sure. So, well, to hit the first one, absolutely. So the industry funds here in Australia, I think that's what you're talking about, have huge allocations to private equity, and they invest directly. So they're investing in proper private equity funds where they put their money up. They won't get it back for 5 to 10 years. They've enjoyed tremendous returns. And, you know, as an outsider looking in, I think that's the right allocation. You, as a big fund like that, you probably should have some allocation to private equity. Just to say, though, I mean, one of the criticisms of the industry fund model is that as your membership starts, you know, we've been through a period of growth where industry funds have grown a lot of assets and had a lot of younger members coming through. Looking out the next 20 or 30 years, sadly, you're going to have less and less members and people drawing down. And I think one of the criticisms of the industry funds' big allocation to private equity is how do you match your liquidity with the needs coming up in the future. And another issue that you see come up a lot is how they mark those portfolios. So if you're investing in something that you're not going to exit for 10 years, what value do you ascribe to it along the way? And if you have a member that comes out and wants to take their superannuation out, you've got to let them out at a price. So that's one.
Particularly if you've got a $3 million limit.
Exactly.
Suddenly you've got to value something that's very hard to value.
And someone's just, right, exactly. So I think that's a legitimate kind of, legitimate point of concern. And then to your fund, I mean, I think it just shows, what you're saying, back in the day they're expecting 30% return.
The 1980s
Yeah.
venture capital, 30-35% return.
Yeah.
You only go there almost as a last resort.
Yeah, so it's flipped in a lot in certain industries, and certainly in the US, it's totally flipped, where it's basically the first port of call, and it's such a large and sophisticated market now that you can really target whatever you want. So if you've got a really high risk, high reward kind of business idea, there'll be guys that want 30 or 40. If you've got a widget that you want to make that's going to generate teens return, there's venture capitals that bank that, and there's multiple rounds of venture capital financing and multiple different types of financiers. And you know, increasingly, this stuff's just not coming to public markets. Yeah, it's changed a lot.
Does anyone have a question for Mark?
Sorry, yeah, I'm still. Why don't you
Yeah, go,
sides?
please.
The euro and the UK look more energised than they have for a while. I mean, how's it sort of playing out?
So they look more
Energised.
Right, okay,
It feels like,
But it wasn't hard because everybody was so down on the UK.
been a disaster.
About a year ago, everybody was going to move their listings from the UK to America. Everybody hated Europe. So, I mean, I think it couldn't have got any worse, really, for the UK. Everybody was putting out of the UK. But, sorry.
So capital seems to be flowing in.
Yeah.
About the UK as a value market now, etc.
Yeah.
How are you seeing it on the ground? What opportunity, where are the opportunities?
Yeah, no, I mean, that's definitely been the case. I mean, we speak to all the sort of local brokers in the UK. They're all doing fantastic business. There's just been tons of secondary flow coming back into the European and UK market. So, yeah, I mean, we're seeing that. Yeah, we see that in M&A as well. So any companies that do sort of lag. So one of the examples we had as well is a property a fund that got taken, well, the portfolio got sold, but there's been a huge amount of M&A in the investment company space, in real estate companies in the UK. So yeah, no, we're certainly seeing that. A lot of money coming into the UK. Quite a few of the, I mean, we had I think the case study that we probably talked about last year was a song royalty fund. There were two song royalty funds, and both of those got taken out by private equity. Again, taking advantage of the UK discount that existed. So yeah, I mean, it was there. People are noticing it. People have come in and taken them out. But we're certainly seeing a total change in sentiment towards the UK and Europe, partly because it couldn't have got any worse, but also because Trump's, I suppose pushing people a little bit away from the US, really. You only need a little bit to come from the US to go into UK and Europe, and it makes a big difference.
Spare change.
Yeah.
How does that affect the sort of exits you might be looking to make then? Is that in the next couple of years?
I mean, M&A is one of the sort of scenarios we have for some of the investments we made. So again, going back to that Song Royalty Fund last year, or the 2 Song Royalty Funds, M&A was a big part of the thesis there. The other part of the thesis was one of the features of UK funds. I don't know if you're familiar with them, but typically when they list, within their prospectus, they say after 5 years, we're going to have a continuation vote. So we're going to go back to investors and say, is the opportunity set still there, and should we carry on in this form? And those aren't a formality. That's a good opportunity to sort of reassess the whole vehicle. So one of the scenarios we have when we make those investments on a really, really big discount to NTA is, could this get taken private? So we look at some of the transactions in the private space. The second one is that they've got this continuation vote, and you've got a shareholder base that's really, really unhappy. We know those shareholders, we know what they want. So that's the fallback option. So it's certainly a big part of it. In the case of, again, this property fund we could have talked about, it was called Aberdeen Property Income Trust. That was a very, very simple real estate investment trust listed in London. That had gone through a process of M&A, which shareholders voted down in favour of just selling the assets one by one. So we didn't invest to use M&A as our exit, but the fact that this M&A activity had happened provided us with an exit opportunity in that particular case. So no, I mean it's good to see, because ultimately you see transactions happening in the private market, and there's only sort of so long that the public markets can trade on that massive discount if you've got the right corporate governance in place and the right shareholder base in place before people have to ask the question, is this in the right form, really?
Oh, yay, yes.
Remind me if this is a trivial question, Mark.
No.
What do you make of Land Lease and the Crown Estates doing some kind of joint venture, which I've read about?
Oh,
So
wow.
can you provide a little bit more information? I'd say.
Lend
I
lease.
read that Land Lease has done some joint venture with Crown Estates, the royal family, to develop properties.
I don't know enough
We
about it. I
don't
don't know enough
know.
about it. I don't think to comment.
Although we do know the guy who founded Lend Lease. He lives in Avalon, doesn't he?
I don't think so.
Yeah, Dave,
you and Dave. Mates.
whatever. No, I don't know. Sorry, I actually don't know anything about those.
The UK market's a bit funny. I mean, so the Crown owning large amounts of land, and a lot of those kind of old dukes and governors.
No, he's
owning-
talking about Crown here.
Oh, Crown
and
Estates.
Lend
You said
Lease.
Crown Estates, right?
Crown Estates, and the royal, like the Crown Estate.
Yeah.
Oh.
Yeah. So the UK, I mean, we're doing a lot in real estate at the moment. There's some very cheap assets out there. We've made a few investments. We haven't invested in the Crown Estates, but it's a funny
Try
market.
and wind that up.
Yeah, exactly. I think that's sedition, isn't it?
Yeah, that's terrible.
But the Crown Estates, and I was saying, you have lots of sort of old families that own large chunks of London. It makes it a funny market. But yes, sorry, we don't know much about that one.
I know most of your acquisitions are probably over a long period of time, but when Trump announced his today's a great day to make money, Truth Social discussion, does that give you an opportunity to get in really quickly to do those sorts of things, or is that something you're not interested in and you're only talking about?
I think we're not really in the, unfortunately we're not in the little kind of Trump investment club where we got a heads up on that, or the crypto. We could have bought some Trump coin. Yeah, no, I think, like we saw that day. I think around that whole kind of episode, the key focus was risk management, and we certainly weren't. It's so volatile, so unpredictable. I think later that day, markets had rebounded. We're up 9% that day. I mean,
hence my question.
Yeah. I mean, I don't think it's the kind of thing we would
That's right.
change our positions, because you just don't know, do you?
Sure.
I mean, in hindsight, it was a fantastic, it was a fantastic opportunity. I wish you'd maybe give us a heads up again.
I was too busy speaking my broker.
Buying some Trump coin as well. Yeah.
Hi.
Just want to get your quick thoughts on private credit. There's been a lot of growth in that.
Yeah.
The return sustainable.
Do you you mind if I take that one?
Yeah.
So on private credit. So what's interesting with private credit, I think, which is it's become sort of theme du jour down here in Australia. So loads of funds coming out. I see people talking about it all the time. And it's almost as though like Australia suddenly just discovered it and has gotten all excited about it. So private credit as an asset class has been around for 10, 20 years. We've been investing it for a very long period of time. And certainly offshore, you don't see the excitement that you do here now. I think it's more of a new thing. I can't give you like what's going to happen thing, but I can give you both sides of the argument. So I think one side of the argument, the bullish argument, and it's a fair, strong argument, which is post-GFC, the way banks are run these days, they want less and less kind of traditional lending risk. Australian banks really just want to lend to households on mortgages. It's a fantastic business, low risk, they can leverage it up. They're not taking on a lot of kind of existential risk. So that's kind of meant that a lot of lending that used to happen isn't happening by the banks anymore. And you've also had this big growth of private equity, private credit have come into that space and have come up with some very sophisticated solutions. So I think there's a natural kind of reason why private credit's grown. There's a business case for it. They're replacing bank capital that's retrenching, and they're also being innovative, which they do quite well, and coming up with new solutions to sort of financial problems. So that's why private credit is growing and why it probably will continue to grow. The flip side to that, of course, is Warren Buffett's statement, you don't see who's naked till the tide goes out. There's a lot of money chasing into it now. We've certainly been through a few car crashes and we've watched and not invested in, but watched from afar and come close to investing in. As in we dodged the car crashes. But there's been a lot of people that have gone into it that don't really have the skill set, that are trying too hard to put money to work at a time when everyone's trying to put money to work. And that's not a particularly good equation, particularly with like untested strategies or untested managers. So it is a little bit buyer beware, but I don't think it's some big Ponzi scheme. There's a legitimate reason why this is happening, and there are definitely good operators having it with a great business model. Would be my 2 cents.
The only thing I'd add to that, a couple of points. I think there's a big dispersion between good managers and bad managers in that space. I think you've had some of the sort of the big names come here and list vehicles. In some of the UK names, we've had some poorer vehicles, poorer managers in that space. The other thing is that these portfolios can tend to be very concentrated because you are, you're writing, these are private contracts with companies that are borrowing from you. So you can tend to have maybe sort of 10 to 20 names in the portfolio. Given that when you're lending to a company, you've got limited upside and 100% downside. I think diversification is never more important than when you're lending, and so those are the sort of 2 things I'd say. I think there have been a lot of blow-ups we've seen where you've had an inexperienced manager that's sort of just jumping onto the next sort of bandwagon and running too concentrated a portfolio with those loans.
Another one from Mark. Mark, your kind of perspective from Great Britain and across the Channel. There seems to be a kind of increasing sense of common purpose between UK and quite a bit of Europe. That's just kind of my sense of it.
Yeah.
That may not be the case, but if so, what impact do you think that'll have on the economy in that part of the world and possibly investment opportunities?
Well, I think we're already seeing it. Perhaps you heard that the UK and Europe have just. I think like any improvement in that relationship between the EU and UK is going to be good for UK investors. I mean, personally, I sort of understand why people voted for Brexit, but I also didn't. I voted to remain. So I think economically that's been a disaster for the UK. So I think any sort of any improvement in that relationship between the UK and Europe is good. It's fantastic. And it's great for us travelling abroad because we have to join these huge queues at the moment when you go on holiday. And, so much nicer. You see all these Irish people in this, fast tracking through. So, I think, that definitely it seems to be improving. I think the whole Ukraine situation has brought everybody together.
That's what I was going to say. The UK has got a big defence industry. It's one of the big security countries in Europe, and that common purpose, I think, is really...
Yeah, Trump has caused that a little bit, hasn't he, with the forced spending, defence spending.
Yeah, it's like when I tell off one of my kids and they both shout at me, they both turn against me. It's sort of like, Trump sort of told people off and they've all kind of turned on him, so I think... Sorry.
I was just going to say, do you think that the possible investment opportunities are kind of obvious now, or they come a little bit further down the track, but this sort of increased sense of
investment opportunities?
I mean, the thing in terms of what's been announced, it's as Mark was saying, you're coming off a very low base, so it probably helps GDP growth in both countries by a minuscule amount. But I think the more optimistic thing is that at least both sides are talking now, and I think the big win that came out of it is really not so much what was announced today, but was the announcement they're going to do this every year going forward, and they're going to keep talking. So sadly, I don't think it's like a...
Are there increased opportunities for us?
Well, I think, like, you know, to the extent we're taking advantage of the outlook being so bleak for the UK and these huge discounts persisting, and there's an improvement in the fundamentals, that has to be helpful to us, because it just means you've got more likelihood of some outside investor who is thinking smartly about the whole thing coming in and seeing a rationale and taking it out. So it should do, provided those discounts are still there.
The absolute or for kind of
Yeah.
Particularly in those that are invested already.
Yeah.
Yes, one of the case studies you've talked about in the past was the aircraft leasing company.
Yes.
Are you still invested in that, or is there any update?
Yeah, so we're still invested in that one. I mean, just for background, we've talked about it in quite a few times actually, but back in 2020, we invested in this aircraft leasing fund. At that time, it was trading below its cash on the balance sheet, so it sold 2 aircraft, probably the best time aircraft sale ever, in February 2020, just before the pandemic. So it sat had £130 million of cash on its balance sheet and a market cap less than that. So we bought in, and we were getting the aircraft and 12-year leases for free there. It paid out a big chunk of that cash later that year, and it's performed fantastically. Actually, it's been a real winner. I don't know exactly what the return is so far on that, but it's made several capital distributions since then of this surplus cash. I mean, it started off holding back a huge amount of cash, and over time it's become more comfortable. It continues to pay this very high yield, like a kind of a teens yield, and it's still accumulating cash even after paying that, which it then pays out in lumps every now and again. The outlook for the A380 is the sort of controversial aircraft that fund owns, and as you probably know, it's a fantastic experience flying on an A380, but the only real airline that's adopted it and took half of them was Emirates, who thankfully is who we have our leases with. There have been several funds in the UK that were launched to own A380s and lease them to Emirates, and at the end of those leases, Emirates has bought all of them so far. So we're getting a better sense now. So previously, when we made this first investment, we were just investing because we were getting it cash. We were buying all this stuff for free. Over time, we relied on the contractual payments that Emirates would have to pay at the end of those leases. Over time, we're getting a better sense of what those A380s should be worth if we're being conservative. And we've got loads of data points now. So we still hold it. And it's done very well, and it still looks attractive to hold.
It's done tremendously. I think we've trimmed it.
We trimmed it back a bit. I mean, even though they've been making these huge distributions, the shares have done so well that we trimmed it back from a sort of risk management perspective. And obviously, as this thing gets more expensive, there's a certain element of the price rise that's justified by the fundamentals. A certain amount of it is, it's lowering your future return. So we have trimmed that back in line with the prospective return there. But
we still hold it. I mean, one maybe we won't talk about too much today, but one we might talk about over the next few years, and I'm just going to throw you a hospital pass, is we own a bunch of airlines we bought during COVID. At the moment, we're in the middle of a trade war, and we're out there buying container ships at 70 cents on the dollar. I don't know if you want to say it.
Well, not container, actually, bulkers. So we actually own, there's a fund in the UK, trades on a very deep discount called Tufton. They changed their name. It was Tufton Assets, I think it's called now, but it owns product tankers and bulkers. Trades on a big discount, as I say. Good management team. They did a really great job, and actually they did used to own containers, and they sold them pretty much at the peak recently. Post-COVID, when you had this huge demand for containers, they managed to sell theirs, flip theirs out into that, and move it into something else. What's really interesting about that fund is that it's got a realisation period from 2028 onwards. So they've turned around and said, we're going to give you your money back. We think the opportunity set runs till 2028. From 2028 onwards, we're going to be in the process of selling these ships down and returning your money to you. So, you've got the return from a portfolio of ships that they've leased, run by a smart manager, and then you've got this huge discount that you're taking out over that period as well. So
thematically, it's not that different to buy, and we're not buying them as cheap as we bought the aeroplanes, but it just sort of is interesting to say we're now buying container ships because we're in the middle of a trade war and we're buying cargo ships cheaply.
You've alluded to the geographic allocation of the portfolio. But can you say a bit more about that and how you see that trending?
Shall I do it? Yeah. So our primary investors, we're investing into listed funds all around the world. So we might invest into a listed fund in London or a listed fund in Singapore, but its underlying assets will often not be in Singapore. So just to say, so the vast majority of opportunities in the world are in the US. It's the biggest capital market. It's the most dynamic capital market. So around half of our assets are normally in US dollar related in some way, either equities or credit. Then there's another big chunk of opportunities in Europe and Asia, so it's sort of been 20% each over time. And that hasn't really changed through time. It's just a function of the opportunity set. We might access them through a Canadian fund going into Europe or a Mexican fund going back into the UK. But in terms of the underlying assets that we own, it is very diversified. It looks a lot like kind of the broad cross-section of the global economy. And we deliberately target that to manage risk and keep it a bit dull, but also lower risk. Yeah.
My question was more the same.
Oh, cool.
The question underlying geographic assets.
Okay, cool. Cool. Yeah, two, yep.
Is there any recent GVF investments that you can talk about and why you've purchased them?
There's a couple, but normally when we come out, we'll do a case study that's just finished and a case study that we're in right now. We do that so that you can come there and hold us to account in 6 to 12 months' time. There's a couple we're building right now that we're really excited about, but we're also very conscious that our competitors are watching the videos and reading the stuff that we put out. So unfortunately, we chose this time not to do that. There's one we have talked about publicly, which we've been in a long time here in Australia. This is all obviously buyer beware, but we are a large shareholder. We've talked about it in URF. So it's a property fund listed in Australia. It used to be the old Evans Dixon's property fund. It has a very checkered history. Because of that checkered history, it blew out to an enormous discount. We were the largest shareholder, and now we're sort of equal largest shareholder. Mark has done a sterling job behind the scenes there in knocking that into shape. A few of the grey hairs, URF related. But now it's a nice clean story. It's still on a large discount, be a discount about 30%. They're in an interesting portfolio of New York and New Jersey properties, residential properties, and they're in runoff. There's no fighting or argument to do. They're selling the assets, they're giving the money back to shareholders in Australia. If they can sell the assets in line with book value, and they've done
a huge amount of that. Yeah, they're selling generally about $20 million worth of assets every month, pretty much bang in line with where they've got them valued. The only thing you've got to account for is you have to pay sort of extortionate cost to sell things in the US. It's something like 6 or 7% sales cost, but you can bake that into what you expect to come back.
Yeah. So we see this really interesting discount. The discount's going to come out as they sell the properties, and you're exposed to US property prices along the way.
They've got a ton of cash. Actually, one of the interesting things about that, we talked about it in October in some of our slides. They've been accumulating cash, and we had hoped that a huge chunk of that would come back early this year. Unfortunately, they've got a covenant. They had a covenant on their debt, so they could only reduce the size of the company below a certain amount, which prevented them paying a bigger distribution. However, they've now renegotiated that, so they should be in a position to start making meaningful distributions now.
So a follow-up question on that.
Yeah.
Jeff Wilson is obviously a board member of GVF, held URF in war and has publicly said that they've sold it because the remaining properties, they were concerned that the values weren't going to continue hitting book value, etc. Like, what's your view on that, since he's publicly sold and suggested that's why they got out, they've got their valuation hit?
So a couple of things. One, we were in URF a lot earlier, so our entry price is a lot lower. And then I guess the other thing, the valuations has been kind of the bugbear since the beginning. So when we first started looking at that, we had a lot more concern about, are these properties worth it? We've done a load of work on how they value the properties. We think it's a really robust kind of formula. And they sold $200 million of properties at book value or thereabouts initially when we first were involved to help pay down debt. They're now re-engaged the selling program.
I can't remember, but it must be over $500 million worth of assets they've sold now.
We're less worried about that. The manager selling them is a properly incentivised. The manager selling them for us in New York doesn't make any money unless they sell them at or above book value, and they've done a really good job so far. And we do a lot of our own research on what property prices are like. I mean, in part, possibly, I didn't know that about Jeff. But
I didn't even know he was on the register.
I didn't know he was on the register. I didn't know he's come off the register, just to show you how independent we actually are.
Yeah.
But I mean, a part of that too is probably possibly a view on interest rates and things like that. So what are US property prices going to do? But we're much more positive on that. And I guess the thing, I mean, a big part of what we do as value investors is that idea of a margin of safety. So there's still like, our property price is going to fall so much that it wipes out a 30% discount. We're generally more relaxed. Yeah. I hadn't known he sold, that's good to know.
Just one final one for me. When you think about discount capture, which is a fair part of what you do you have any sort of guardrails on if you buy something at a 20 or 30% discount, do you then get out of it when it's 10 or 15, or is it
absolutely
vary by industry and by?
Yeah, no, absolutely. So everything we go into, we're thinking about how much discount capture can we add on top of the underlying asset class, how much return are we going to have, excess return for owning equities or owning bonds or owning cargo ships. And if the discount comes in a long way, obviously the prospective return comes down a lot. So every month we have a meeting between all of us on every single position. Are the prospective returns still good enough to justify the risk that we're carrying? And I mean, that is a feature of our strategy. Sometimes we are a bit lucky. We buy something cheap, we have a plan in place, but we don't ever get a chance to implement the plan. The market just takes it higher, and we are very quick to tip things out.
It's worth just talking about the, we probably look at discounts a little bit differently to I think a lot of other people that do discount stuff. You'll see a number of sort of competitors of ours quote things like look-through discounts. The way we think about discount capture is per annum. So over what time frame are we expecting it, and is that a fair compensation for the risk that you're taking with that asset? I think that's a sort of slightly different thing. So, something may be a fantastic investment when it's on a 3 discount. Because you're going to take it out in a couple of months versus
something that might be on a 50 discount, but is always going to take you 15 years. It sounds exciting, but it doesn't really do much for you. Yeah. Thank you very much, everyone. I really appreciate your time, and enjoy your lunch. We'll be around to keep chatting.